Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, we are retracing 161.8% of that last decline. However, like I said earlier, I do find that the 138.2 seems to hold a lot better. There are also other Fibonacci levels that are made by taking square roots of these different things and also applying them. For those of you that have known me for quite a while, though, you know that I like to stick to the most simplest methods possible. So I'm not going to go into a lot of advanced type of analysis, particularly in using indicators. A lot of you might even be surprised that I have used Fibonacci and do use it, simply because I do say, for the most part, that I really don't trade with many indicators at all. I'm kind of gotten to the point where I don't usually draw the Fibonacci lines on my charts anymore because I can pretty much visualize and see where they're going to fall without having to do that. But for anybody that's a newer trader in particular, this is one tool that can give you that extra visual input as to where the support and resistance levels are. The longer you've been trading, the less you're going to need these types of crutches, and you can focus more upon the pure price and volume action. But they do offer a really good form of assistance, especially if you're finding that you're having difficulty with placing these target zones. So you can see here that at C, on this USD-CAD pair, that it held that level almost perfectly. The Fibonacci retracement level for 138.2 was 1.2944, and you can see that it came very close to that. It came a little bit more into the 1.3, but still very, very close. Another example of this is not very long ago, just a couple of months ago actually, I gave the USD-JPY pair as a trade. And on the currency pair, it was a short. For the option, you would be looking on the other direction though. I'm sorry, that's a mistake there. It would be a short here too as well. I actually took the USD-JPY pair in the ETF for the currency, though. I was trading primarily stocks at the time, so that's what the platform that I had open. So I'm going to show you a chart of that, though, here in a minute so that you can see how even if you're trading the options where the foreign currency is paired first, but you're looking at it the other way around with the option pair, you can flip the charts over easily. Sorry if I got a little tongue-twisted there. But what I want to show you here is with the USD-JPY pair, if you're looking at the previous decline, you would start drawing your Fibonacci level here up at this high, take it into this low, and this gives you your projections. What this did was it projected these levels of resistance on the upside. For those of you that followed my previous classes, you'll know that typically 3 waves of upside exhaust a trend. And in this case, we have a momentum reversal pattern as well because that initial wave of upside was substantially longer than the 2 which followed. So then we're followed by some slightly higher highs. And even though that first Fibonacci level created and led to a congestion in there going into the second wave, coming out of that second wave of buying, you can see that it hit a 50% retracement right in the 110 zone on this. And I was looking on the short side in this currency. So what we are seeing here is we also then go and apply the Fibonacci levels to that bounce off of the lows and up into the highs. So in this case, we're not looking to use it initially as a target placement zone, but rather using the support and resistance levels from the Fibonacci to help time retracements and help time reversal patterns. So by coming into these support or resistance zones, it gives you a really good heads up that not only is it likely to stall here, but if you have other technical signals, such as the fact that we had this three-wave of upside here, then it's going to serve to get you into a lot of reversal patterns as well. In this case, I had an entry in September. You can see as this previous low broke, it had come off a small, very tiny head and shoulders pattern here on this daily time frame. You could see a lot better if you pull up like a 60 or 90-minute chart. And I had actually missed the initial trigger for this because I like to go down and kind of take smaller triangle breaks or that type of thing. This tool here is a little fat. Not sure if I can make it thinner or not. Maybe make a pencil. Okay, now that's a little skinny. But there was a little bit of a triangle here. And usually I like to drop down and look for that type of thing to get into this type of pattern. You can also draw trend channel line breaks, that sort of thing. Get into it using like the head and shoulders pattern. But one of the things when you're looking at head and shoulders pattern is that instead of using a traditional neckline break where you are taking a break of the lower end between these two shoulders here, go ahead and draw a channel that is based upon that right shoulder and take a break of that instead. Your chances of success are about the same. However, you often can take about 2 to 3 times a position for your size than you would by taking a neckline break, and still, of course, have the same amount of risk since your stop would be above this level here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.